Hi, my name is Chester Johnson. I'm here today with Mark Robertson. Mark Robertson is of Manifest Investing, and I am honored today to have him come on and let me interview him. Before I interview him, though, he's going to talk a little bit about Manifest Investing and explain what it does and what it is.
Well, thank you so much. I'm the one who's honored. I appreciate the opportunity to share a little bit about investing. Just to give you a little bit of background, I have been fairly heavily involved in what might be called the modern investment club movement. And really what that boils down to for somebody hearing that for the first time, because investment clubs aren't quite as popular as they used to be, they're still pretty darned effective. It comes down to the notion of discovering high quality, better companies and doing it in absolutely any market. I started as a volunteer educator in Chicago back in the early 1990s, working with groups of investors who were just trying to figure out which end was up in the realm of investing, and ultimately was recruited to join the Better Investing staff near Detroit, Michigan. Better Investing is a monthly publication of the National Association of Investors. The organization is also known as Better Investing. So I was senior contributing editor for that publication for a few years, better part of a decade. Had the opportunity to work with many successful investors and take some notes. We'll talk about that in a minute. But really what it comes down to is this notion of very long-term perspective and context. What you're looking at on the screen is a kind of a go-to slide for us. The green bars are the stock market as represented by the value line arithmetic average. So that's basically the average of about 1,700 companies that are published by the research service known as Value Line. We love Value Line as a research tool. And you can see that they do zig and zag up and down. The blue line is nothing more exotic than a regression trend line through those data points. So again, you can see the zigging and the zagging, and they seem to actually follow that blue line pretty well. So again, for a fairly young person involved in the market, you want to understand that this is something that is just natural. The terrible disruptions that we had 10 years ago with the Great Recession, along with what we saw in December of 2018, and then most recently with everything that's happened since March of this year. That's going to happen from time to time. I think one of the biggest mistakes that a young person will make when it comes to the challenge of investing is watching it too closely. I mean, you really want to have your eyes on that blue line. You want to understand that those white spots are uncomfortable. They actually, for us, represent opportunity, and I'll describe that in a second. But again, those white spots are, the distance between or the little gaps between the blue line and the green bars. They really are moments of opportunity. They will be gruesome moments when it can be hard to invest. But what you want to do is grit your teeth, basically go back to work and keep chugging that money into your 401k and just stick with it over time. We'll tell a couple more stories about why that is so important. So again, Shasta, I think the thing that sets us apart from most of the investing world, people who follow our method basically do try to build an image of what lies ahead for all of the companies that we follow and track. Again, we're always trying to find great companies at great prices. And those red lines, the red graphic that you see there, could be thought of as the average return forecast for the companies that are in the Value Line Research Service. So again, during those big price dips that you see on the screen there, those are actually, when you see the red line peaking out as it did 10 years ago, and it is most recently has in March, those are literally those back up the truck moments for us. You turn on your nightly TV, the news anchor is going to tell you how much your 401k lost today. We simply turn off the TV and go shopping for great companies. That's the response to that every single time. Any question on that, Chaz?
No, it's good stuff.
All right. So what is it all about? I'm just going to very quickly go through this. Again, this is something that's been 8 decades in the making. We believe that anybody can do this. We care about the returns. And what we basically do is characterize any investment, mostly stocks, but it could be funds, into the return forecast, which we refer to as the expected return or the projected annual return. And then we think that the quality or investment grade of the companies really matters. So we are continuously hunting among the best companies, trying to find the best companies and owning them for as long as it makes sense to do so. It really is that simple. Why manifest? Well, there, you can use the Webster's definition up there at the top. We think that some of the stuff that we do in the Modern Investment Club movement is to take stuff that can be quite challenging, especially somebody who's math phobic, show how you can actually do it with pictures. You can do it with numbers if you want to on a spreadsheet, but you can make it something that the average investor can do. One of the stories I like to tell is about one of the young people in our investment club in Chicago back in the early 1990s. She was terrified of math. I mean, we would start into the investment club meetings and she would practically have a seizure, or she'd go out and run around in the backyard and, just having a real moment. And we worked with her to show her how we could do some visual stuff because she was very artistic. And next thing you know, a couple of months after being terrified, she's actually coming back to the meeting showing us these visual analyses of the business models and just unbelievable. Completely took the fear out of it and suppressed the numbers so that she could thrive as an investor. In fact, she was featured in an article in Money Magazine back around the year 2000, telling the story of how successful she'd actually become just because she conquered that fear. So really, it comes down to focusing on a few key things that are important and latching on to stuff. So good stuff. It really is this simple. You know the guy on the left there, right?
Oh, yeah.
And somebody one day made fun of me because I'd made a comment about Warren putting his feet up, and they kind of abused me during the presentation. I came back the next time with that picture. Well, he shows him with his feet up in the air, and I can actually see him closing his eyes and taking a deep breath and sipping on some cherry Coke. Again, it's just this notion of you can't imagine what the company might look like in 5 or 10 years, and what would it be worth under those conditions. One of the reinforcements of what we talk about all the time is the notion of Warren Buffett buying 10% of the company that is Coca-Cola back around 1990. It was right around 1988, 1990, his company actually became a 10% owner in Coca-Cola, a stake that they hold to this day. So anytime he's a human computer, basically what he does when he's thinking about any investment opportunity is just what you see there. Closes his eyes, kicks in his own version of computer chips in his own head, and thinks about his imagination or vision of what that company might look like in 5 to 10 years. In fact, you've probably heard the quote that he invests as if the stock market might as well be closed and no trading allowed for the next 5 years or 10 years. And how would he think about that investment under those conditions? So we emulate some of that in the things that we do. Right? Just a couple other fun facts that, again, when I'm working with younger people that perhaps have access to a 401k or just are investing in their own personal brokerage accounts, we want to encourage them to find the best companies at the best prices and continuously do that. Invest regularly, much like you would in a 401k. And this is actually a demonstration of a 401k. It's a model portfolio that we keep at Manifest Investing. And it literally is taking the maximum allowable amount that you could have invested since January 1995. And the blue line is the total assets. We publish every single decision that is made in this portfolio, from since 1995. And you can see that it's outdistancing a vanilla investment in the general stock market, the total stock market, as measured by the Wilshire 5000, and having a pretty good time. Now, the last year has been, I think that qualifies as roller coaster or turbulence. Wouldn't you agree?
Oh, yeah.
I mean, since the end of 2018, we are back to remembering what volatility looks like.
Yeah.
Yeah. You guys can read the stuff on the right just as well as anything. I mean, a lot of the stuff that we talk about is, again, if you're interested in being a long-term investor, we believe that Googling Walter Schloss, that's Schloss, and just reading some of the heritage and his contributions to investing over the years, because he was a professional money manager, I believe, out of Pittsburgh, and he invests just like you and me. Find an idea, put it through its paces, check out a few things, but any investor can do this, and he achieved huge returns over a period of several decades, 39 years, and just incredible investing. He was one of Warren's best friends from the early days of Buffett's investing career. We love this graph to make a point. That's Walter in the middle there next to his son. And again, he literally would go looking for companies that fit this mold of being excellent companies with good balance sheets, wait for the opportunity to buy them under the right conditions. And the way we use this slide in talking with people who are interested in long-term investing is just to notice the difference that a percent or two can make. You want to hold down your costs, you want to be disciplined, you want to do it regularly, and if you can approach those numbers up at the top, just notice how explosive those mathematical totals become over time. So again, the message is climbing up that ladder of incremental returns. Every rung you can jump up that ladder by either holding down costs or doing something efficiently, and the numbers just become massive.
Awesome.
Science fiction, I thought I'd throw this one in here. Attended our session last night at the roundtable. This is a 10-year demonstration of a community of investors coming together to select stocks. And what the bottom line is, the tracking portfolio for the stocks that we have chosen for this monthly, it's a free webcast. You're all invited. Well, I'm sure Chester will want to talk about it a little bit more, but the rate of return on that is 17.4. Again, we've climbed up that ladder pretty well, and we're always trying to either stay there or climb a little bit higher. So it can be done. And then just as a final clinching point, and then we can launch into some of what Chester wants to talk about. This is just a reminder. Power of taking control of your own long-term investing efforts. The guy on the left is Joel Greenblatt, again, another person to Google and understand, read his books, whatever you can get your hands on. Over a 20-year period, a few decades ago, he turned $1,000 into $840,000. And again, the stark, it actually makes the hairs on the back of my neck stand up. If you'd invested that same $1,000 into the average street advice of just buying a stock market index fund, that would have, it's a nice number. $12,000 is better than stuffing a mattress. We believe it's possible for anyone doing this, take it on as a hobby or an area of interest, or just be very diligent about your 401k to get between those two numbers. Between that 12,000 and that 840,000, obviously we would like to get as close as possible to that 840. Not everybody's a Joel Greenblatt. And he'd probably admit that some luck was involved there, but getting between those two numbers is really what we seek to try to accomplish. So hopefully that gives you some idea. I've worked with, I'll stop sharing my screen here.
Perfect.
Basically, manifest investing is the product of working with legions of successful investors all around the country for the last few decades, and trying to capture what matters most and then put that at their fingertips.
Yeah.
Hopefully that gives you some idea of some of the adventures we've been on for a while.
I really appreciate that. I really like manifest investing. I like the community. I really love everything you're doing and the passion you put into it. So I really appreciate you talking about it.
Thank you so much.
Before I ask some questions, where can people go to check out manifest investing?
There's a couple things you can do. First of all, if you want to dive in with both feet, you can go to manifestinvesting.com, just like it sounds. And you can start up an account, a trial account, and we generally run those about 30 days, so you can figure out I mean, the key features that most of our users really gravitate towards are the stock search, the screening tool, and then we have tools for portfolio design and management. But the discovery of the ideas is what really brings people there. Now, we currently offer that for $40 a year. That might seem way too low. It is. I'll do that every day. But think of it as populist investing. We want to make it so that anybody doing this stuff can access it. So you can actually do that. If you're really frugal, I'll use that word, you can go to expectingalpha.com, and that will give you basically an hors d'oeuvre sampler of some of the stuff we've done over the years if you want to get a feel for it. But again, if you want to get into it and find current actionable ideas where a community of investors is digging through them and sharing them.
I'm not as familiar with AAII, but I like their mission. My platform, the Stock Boss Up app and StockTeamUp.com, we're trying to get more, people probably younger than me into investing, people that typically never even thought about investing. We want to spark interest in them. Can you just talk about better investing and as one example, and how can we, why should maybe someone in their 20s or someone just out of college check out better investing and try it out?
Probably the best way to capture that story is take it right to my personal experience. Back in 1995, 1996, I was invited to come to the Detroit area and join the staff of Better Investing magazine. But one of the leaders of Better Investing at that time was a guy by the name of Tom O'Hara. Okay, stay with me on this. Tom O'Hara was chairman of that organization for over 50 years. I mean, how many people do you know that?
None.
In the organization. So anyhow, Tom O'Hara, helped form the organization back in the 1940s. So come February 1948, he started putting $20 a month into an investment club account. Okay, $20 a month, and he never missed a single month. Up into the late 1990s, right when I joined that investment club while being on the staff. So I walk into my first club meeting, and I'd done our stuff in Chicago. We had our tiny family and friends club. So I walk in, and I'm looking at the ledgers and the account statements, and I notice that Mr. O'Hara has a $1.5 million balance in the investment club. Now, that doesn't count his personal investing in real, his real money accounts on the side. And it took my breath away. And he would draw out like $100,000, and we would come back a couple months later, he'd be back to $1.5 million. Okay, and you guys, anybody that doubts this, sit down and do the math. He actually invested $20 a month since 1948. His total investment into that club was $16,000.
Wow.
$16,000. And here he is. I'm sitting there watching him draw out $100,000 whenever he felt like it. I mean, it's just amazing. Now, his rate of return, if you go back and look at his rate of return over the decades for his personal component in the account, was about 13%. So he beat the market by, 2 or 3% over those, multiple decades. So again, it's this notion of coming together with a group of friends and buying great companies at good prices. And that's what we learn how to do. It's just a wonderful thing. So, I mean, if most of the, and again, for more context, that $20 a month back in February 1948 was a car payment. Okay, yeah. Everybody catch that? It was a car payment. So again, to emulate what he did and bring it into current standards, you would think about a young person coming home, whipping open their Robinhood account and making sure they put something like a car payment aside every month, and always do it. Invest regularly, that same car payment every month.
Yeah. Better Investing, I jumped right into it. I should have quickly said, Better Investing is an organization that helps people build investment clubs. I'm currently part of Better Investing. I'm not currently part of a club. That's just because tax reasons. I don't want to convolute my taxes any more than usual, but doing taxes for an investment club is very straightforward. And I highly recommend people doing it because, as Mark said, you have a group of people come together to share ideas and keeps you on that cadence of investing. So thanks for talking about better investing.
You're welcome.
How about AAII? How can why should someone maybe in the early 20s, people that are never invested before, why should they do AAII?
Well, it's the same type of thinking. It's an opportunity to experience and share ideas. Um, Whereas better investing really is focused on stocks and ownership in equities. Um, AA, as they like to call it, is a more broad spectrum of a variety of things. Different approaches to investing, momentum investing, perhaps, that sort of stuff. They don't say that there's a single way that works, and that's true. I mean, it really comes down to make your choice and stick with it. Whether you're in an Investor's Business Daily momentum investor, that's fine. It's something I've never had the stomach. It works
Me
for
too.
people. So basically, you get that exposure. It's also the opportunity to meet people like the current day versions of Walter Slash, or AA recently had a meeting with Joel Greenblatt in Chicago. So you get that. I hope we have face-to-face meetings again someday soon and functions, but you get those type of opportunities to be around people who've been successful in investing and share some of those ideas.
Now, I when we first met, Mark, I was talking about getting young people to invest, uh, people who who've never really been into investing or been exposed to investing, getting them to invest. So I touched on a few resources that I know that I really want to emphasize to people getting into investing. What are your thoughts on other resources or methodologies or ideas that you recommend to young investors and new investors, to get them to invest?
Well, again, I think the notion of what you do with Stock Team Up is a great example of a community where you might discover an idea. I look forward to joining in on more of that type of stuff with you guys. I
I
mean,
didn't
again,
ask him to say that, by the way. I didn't ask Mark
that's
to
true.
say
I
that.
was not paid to say that. Other things that come to mind, fool.com. You probably find some foolish investors out there. You want to become at least aware of the works of Tom and David Gardner and the type of stuff that they do. Hang out at morningstar.com and see what type of stuff sings to you there. One of our favorite things to do with morningstar.com, because we just love sources of ideas, is we'll find companies like Brown Capital Management out of Baltimore, which used to be led by the wonderful Eddie Brown. He used to be on Wall Street Week, probably before your time, Chester, but Wall Street Week with Louis Rukeyser. I'm showing my age here. So anyhow, Eddie Brown was one of the favorite guests on a Wall Street Week show that was on every Friday night. And he formed an investment firm called Brown Capital. They happen to run one of the best small company funds in the history of investing. So we will actually use Morningstar it's closed to new investors, by the way. That's the rest of the story. So we still watch them, and we'll get ideas for potential stocks to own by watching their portfolios using Morningstar.com. So that's another one. Value Line as a source of ideas is another. So those are some of our favorite places to turn to.
Great. So Mark has a ton of knowledge of investing, and I want to go back to ask him normal investing questions because I like to talk about investing. But thank you so much, Mark, for taking a few minutes to talk about young investors and resources they can use. Mark and I are very passionate about getting new investors into investing. It's very important to us, so I appreciate that, Mark. And now I'm going to ask the questions I want to I want to
Okay.
usually ask you. So in this current market, what are you looking at? What are your feels? What companies are you interested in?
Well, it's going to sound repetitive, but we really are looking for good companies at good prices. And a lot of times, some companies will be unduly punished by the economic conditions. I'll throw a name out there. Last night at our roundtable, I featured a company that I actually only discovered here in the last week. The name of the company is Globant, which is going to resonate with many of your younger audience, I'm sure. The ticker symbol is GLOB. And this is a information technology company, much in the likes of Anderson Consulting or Dell Technology Consulting, although Dell Technology is one of their major clients. But this is, again, a cognizant technology, would be another way to think of it. These guys are firing on all cylinders, and their stock price took a pretty good hit between March, April, and May. It got down into the $80 range, and it has recovered since then into the $170 range. So again, we're always watching for that consistent company over the long term. They have a real powerful track record and some real decent vision. So that's an example of a company that we would share.
So,
Go ahead.
so when you saw that company, you like the consistency. What, if we go by metrics first off, what metrics or what raised your eyebrow about that company?
Okay, probably share this on Stock Team Up. What we really do is when we talk about a visual analysis, what we're really talking about is seeing the business model for the company. And that is nothing more exotic than seeing the graph of their historical sales and their projected sales. And that's a straight line. Elon Musk couldn't have a straighter line taking off or landing than this company does. It's just a really nice demonstration of, we talk an awful lot about the excellence of management. These guys are growing the company, doing a lot of business worldwide, a lot of business in Latin America with companies like Mercado Libre, another one to keep your eye on as a young person. So we watch for that. We also watch for consistency of profits. And again, this is a company that has a real nice profitability history and a really strong trend going forward. So that's what we're looking for. And it catches our eye. In fact, I'll tell a short little story. We were at a national convention in St. Louis, and the St. Louis Post-Dispatch had sent a photographer over to interview us and take pictures of our session. And we were putting up these business model graphs, up on the wall. And our audience, probably 100 people standing room only in this room, they were just like being at a July 4th fireworks. We put up a nice looking one, everybody goes, ooh, maybe a little bit of, golf applause. And then we'd put up a company that's really challenged, and everybody would snicker and give up. After we're done, the St. Louis Post-Dispatch comes up to my colleague and me, and he says, "Are you guys some kind of cult?" And it really comes down to, a great company like a Colgate-Palmolive or an Aflac, or when you see it, see consistency and the excellence of management against challenges of all kinds. So that's what we're looking for.
I love to emphasize what's obvious to us, but I'll say it again, just for the audience. We aren't talking about price appreciation of the stock. We're not talking about technicals. We're purely talking about how well a company's doing. And sales is one of those metrics that, if those are going down, that's a symptom of other problems. So thank you for emphasizing that. Going off the rails a little bit.
Okay.
Because I want to give you some out there questions. We might cut this one out. Who knows? But I'm asking for maybe a little bit for personal reasons. So I broke my rules during during COVID-19. I did my normal rules. I bought around March. I talked to you about that already, and that was successful. I actually sold a month ago. I objectively think that the market's again overvalued, but the market can keep on telling me I'm wrong, so that's okay. I kept one position, and I hate talking about it because because I just don't like talking about it. But I'm going to ask you it because it's just too interesting from your point of view. I've held on to Tesla Motors.
Sure.
I don't like the company. I, I but they keep on meeting their numbers, or they keep on surprising, uh, analysts.
Right.
Uh, I don't like that there's a whole bunch of options that the CEO got. I think that's actually a bad sign because it's a dilution process. But uh, you know, a lot of people that watch this are looking at a company like that already. So
Right.
what kind of warnings can you give someone that's looking at a company like Tesla?
All right. Let's come at it from a couple of different directions. First of all, the opportunity. It's a difficult opportunity to envision. And you were there last night. Yeah. Did you catch some of the banter that went around Amazon?
I did, yes.
Okay, so think back to Amazon 5, 6, maybe 7 years ago, and all the abuse they were taking back at the time. Very hard to do a business model analysis of the company. You had to stick to cash flow because they didn't have earnings, and that drives most fundamental people crazy.
Yeah,
We have room
this guy.
in our investing efforts, and yeah, you relate to this.
Yes.
In our investing efforts for what are known as non-core companies, and that can include some of these early stage companies. All right, so going back to Amazon back in that time frame, in fact, one of our roundtable nights is a pharmaceutical scientist by the name of Hugh McManus. He's got this wonderful Irish brogue, and he nominates Amazon in front of, again, a large audience at one of these national conventions, and not a single person voted for his nomination. All right, so you fast forward now to last night, as you heard, I believe we put $1,000 into the model portfolio every time we make a choice. His two-time selections of Amazon, $2,000 back just a few years ago, is now worth over $20,000. Okay, and he used to just say, okay, with some investing, you just have to look at them a little differently. Don't worry so much about those lack of earnings right now; they're coming. I don't know when, and Elon won't tell us. So, or I should say, Jeff Bezos won't tell us in this case. Um, so, it comes down to looking at them a little bit differently. So, in the case of Tesla, and we're going to actually do a series of features on this at Manifest in what we call our bull sessions. We do them every Tuesday at 2 now, and this will be coming up. We're looking very closely at this notion of a projected return on value. So projected pre-tax profits divided by enterprise value over time. So what you have to be able to do for a company like Tesla is envision, where do you really think their profitability could be 5 years from now? Because they now have been profitable for 4 straight quarters. So you can actually do a calculation where you can look at what that return is. This is very, I'll make up a word, Greenblattian. It's very, very related to some of the efforts of Joel Greenblatt to look at a company that's early stage, just breaking into the phase of positive earnings, which gives a lot of us the heebie-jeebies. I get you on this one. But at the same time, there's a possibility Tesla's not as overpriced as everybody thinks it is. Because I'll let you in on a little secret. And that secret is that Wall Street pays too much attention to PE ratios. If you really want to dig in, you can dig in until it hurts. I can show you all kinds of stuff on this subject matter. PE ratios are just one piece of the puzzle, everybody. And if you look at them like Joel Greenblatt, or you can look at that, what does that projected profitability look like? You can actually begin thinking about reasonable returns from even a company like Tesla. Now, I got to admit, this most recent run-up is really pushing the boundaries.
Yeah.
And we talked about, and in fact, the second part of what you asked me, the risk. Think about Facebook. Think about Tesla. Think about any company like that. The guy I just mentioned, Hugh McManus, we were in a discussion not too long ago, and he's an extremely accomplished investor. We were talking about Facebook, and we were talking about this notion of, could it be a Roman candle? Is it possible? And he brought up America Online. And again, this is almost, you're old enough to remember this one, but America Online, that was a raging company 10, 15 years ago. They actually bought Time Warner. Where are they today? So again, for the people you're talking about being careful out there, Chas, you have to recognize that there are some Roman candles out there. There are some American Onlines. Could Tesla be one of them? Sure. It's happened to a number of automotive companies. So that's all part of the prudent diversification challenge. But
Yeah.
right now, to answer your question with Tesla, I might be looking real hard at trailing stop limit orders. For those of you in the audience that don't know what that is, they're abbreviated TSLO. And you want to become educated on what do they do, how do you make them work, what are you actually trying to accomplish. I will tell you that we put a trailing stop limit order on my wife's. She bought Facebook at the IPO, and she's starting to get a little bit of the heebie-jeebies. She's done very well. I advised against it. She didn't listen to me. But we put a trailing stop at minus 20%. So if it drops below 200, she'll exit it. She's going to hang on to a few of those shares so that she can continue to say she invested in Facebook on IPO day. So that is just something to be aware of as an investor. These things can be Roman candles. You got to be able to watch for them. Like you mentioned a few minutes ago, if the sales drop off or the profitability drops off, you want to be vigilant about that. And think Roman candle.
Yeah, absolutely. I brought that one up just because it's just such a unique company. It's so hard to try to use my old tools to look at it. And speaking of old tools, I'm glad you brought up PDE ratios. PDE ratio is price divided by earnings. It's a classic tool, but I agree with you. I've learned the hard way. It is not the end-all be-all tool for an investor. A lot of these tech companies that have done really well, man, their PE ratio was out of out of this world.
Absolutely.
It wasn't even in the realm of a normal PDE ratio. They were in the hundreds. Sometimes they got into the thousands, but they've succeeded. So definitely like that advice. Do you have any other thoughts to give to the audience about investing?
I guess the one I would come back to, again, another short story. My mom and dad were with me at one of these investing conferences. This is in Springfield, Illinois, several years ago. And I came down for breakfast, and I found that they were sitting at a breakfast table with a representative from Biomet. That's one of the companies that makes artificial joints for replacement joints, knees and hips. And they're sitting there talking away, and the subject of conversation was, wow, if I'd only bought Microsoft back when. People constantly torture themselves with, well, what if I'd have bought Apple when we just first found Steve Jobs and stuff like that. And the Biomet person said, well, you know what, we may be boring and we make knees and hips and boring little company, but if you had invested $2,000 in Biomet back in around the year 2000 or whatever, maybe in the 1990s, and anyhow, he was sitting there with my mom and dad, he said, you'd now have $1 million. And I'm like, oh, I hope that investor relations person is telling the truth as I'm gritting my teeth. I went home and checked the math, and she was right. And so my dad is sitting there going, he says, back during that time frame, I was actually thinking about what to do with my IRA and what to do with $2,000. And I could have, if I had been looking for better companies at a good price, I might have discovered Biomet. And that $2,000 just might have become 6 or 7 digits. And this is what can happen with the power of time. Think back to that original chart I put up to that blue line, and what Walter Slosh has taught us about climbing that ladder. You find a good investment like a Biomet, you don't have to have Microsoft. And by the way, Microsoft continues to continue to reinvent themselves and dominate. I don't know how they're doing today on Capitol Hill, but they're probably there with all the technology giants.
They give so many no answers during those presentations. I don't even bother listening to them.
I'll check in for the highlights.
Yeah.
I'll wait for Morning Brew to get. Here's a commercial for Morning Brew. For them to give me the highlights tomorrow morning in my email.
Yeah, when Mark Zuckerberg had explained that his company makes money through ads, I just gave up. I just gave up watching any of that. I don't care anymore. It's a pointless exercise in my mind now, or at least watching it. Maybe it's a good exercise to talk, but not a good exercise for me to watch it.
Yeah. Well, you
Uh,
mentioned, especially for the young people in the audience, we've been kicking around this book by George Gilder, and the title is Life After Google. And it's a fascinating read. It's not an easy read, but the reason we're going into it, again, this thinking of Facebook as a potential Roman candle, and I'm not saying I believe that's going to happen to Facebook. I'm just saying it could happen. Deal with it. Gilder goes on to assail the business model of Google and companies like Facebook. It's a traditional advertising model, and questions whether or not that's a sustainable approach to doing things. And it's really kind of fascinating. And then he goes into blockchain quite a bit. So we want to understand that. See, even the old people like us, can sometimes latch on to an area of promise if that's what it's about to be.
Absolutely. Well, Mark, thank you so much for talking to me today. I really am. I really appreciate it. Mark
You're most
Robertson,
welcome.
Mark Robertson of Manifest Investing. Check out his website, and for all the young investors, please check out also Better Investing and AAII. Just more resources for you, the better. Mark, thank you.
You bet. And watch for me on Stock Team Up, and we'll be sharing some of those ideas, and you get a chance to follow up with some of the questions that you might want to explore. Thank you so
Awesome.
much for the invitation to be here.
Thank you.